The U.S. India tariff war, energy, economics, and global power shifts. In the complex web of global trade and energy politics, certain events act as catalysts, triggering economic ripples that extend far beyond their immediate participants. The recent escalation between the United States and India over energy sourcing is one such event. At the heart of the dispute lies a 25% tariff imposed by the United States on all Indian imports, with threats of further escalation. Officially, the move is a response to India's continued purchases of Russian oil and military equipment, decisions Washington argues undermine sanctions intended to pressure Moscow. But beneath the surface, this is more than a simple trade disagreement. It is a test of economic sovereignty, a contest over energy diplomacy, and a signal of shifting geopolitical alignments in a multipolar world. The chain of events began in late July 2025. After months of warnings about secondary sanctions and trade penalties, Washington moved forward with a blanket 25% tariff on all goods imported from India, effective August 1. This measure came with an additional threat: tariffs could rise to 100% for any country that maintains significant economic ties with Russia. The immediate market reaction was sharp. India's benchmark indices, the Nifty 50 and the Sensex, fell by approximately 0.31% and 0.36%, respectively. The Indian rupee weakened against the US dollar as investors weighed the implications for trade flows, currency stability, and GDP growth. While this decision directly impacts the $118 billion annual goods trade between the two nations, its reach extends far beyond the immediate value of tariffs collected. It sets a precedent for linking trade access to compliance with a broader geopolitical agenda. Why India has not changed course. India's position is rooted in economic necessity and strategic autonomy. Since the start of the Ukraine war, Russia has offered oil at steep discounts, often below global benchmark prices. For a nation where energy imports account for a significant share of the trade deficit, such affordability is a powerful incentive. Today, roughly one-third of India's crude oil imports come from Russia. This shift in sourcing has helped moderate domestic fuel prices, support industrial production, and sustain economic growth in a period of global volatility. From a policy perspective, India has consistently argued that energy security cannot be compromised for political alignment. In a fast-growing economy of over 1.4 billion people, ensuring a stable and affordable energy supply is considered a non-negotiable pillar of national stability. The economic impact on India. GDP growth. India's Ministry of Finance estimates the tariffs could reduce GDP growth by between 0.2 and 0.5 percentage points in fiscal year 2025 to 26. Independent forecasts generally converge around a 0.2 to 0.3% impact, though some warn of higher losses if the dispute escalates. Given India's projected growth rate of approximately 6.3% for FY26, this would represent a meaningful, but not catastrophic, slowdown. Sectoral exposure. The most immediate effects will be felt in export-oriented sectors. Textiles and garments. India is one of the largest suppliers of apparel to the US. Higher tariffs make these products less competitive, potentially shifting demand to other low-cost producers. Gems and jewelry, particularly polished diamonds and gold jewelry, a high-value segment heavily reliant on US consumers. Automotive components, a growing export sector that could lose market share to competitors in Southeast Asia. Agricultural products, spices such as cumin and psyllium husk are niche exports that face sharp price sensitivity. Early estimates suggest cumin exports to the US could drop by as much as 15%. Regional vulnerabilities. Certain regions will bear the brunt of these changes. Punjab's Ludhiana district, a hub for garment and machinery exports, anticipates up to 1 Indian rupee lakh crore in potential order cancellations. Financial markets and currency. Equity markets reacted negatively to the tariff announcement, reflecting investor concerns over earnings pressure in export-linked industries. The rupee's depreciation adds further strain by raising the cost of imported inputs, particularly in manufacturing. Resilience factors. Despite these challenges, India's economy retains significant buffers: strong domestic consumption, which accounts for over 55% of GDP. Ongoing infrastructure investments, which sustain demand in steel, cement, and construction. A dominant services sector, particularly IT and business process outsourcing, which is less exposed to U.S. tariff policy. The economic impact on the United States. GDP and growth outlook. U.S. tariff policy in 2025, including the India measures, is expected to reduce GDP growth by approximately 0.9 percentage points. The Yale Budget Lab estimates a long-term structural cost of around $160 billion annually in lost output if such tariffs persist. Inflationary pressures. By increasing the cost of imported goods, tariffs act as an indirect tax on consumers. The average American household could face additional annual expenses equivalent to around £3,800, $2,024, spread across higher prices for everyday goods. Sectoral adjustments. Advanced manufacturing may contract as supply chain costs rise. Non-advanced manufacturing could see slight gains if domestic production substitutes imports, though typically at higher cost. Agriculture and construction, potential declines as tariffs shift resource allocation and dampen demand. Consumer market impact. Several categories are expected to experience noticeable price increases: apparel and textiles, where India is a major supplier. Electronics and consumer goods that rely on Indian components. Spices, herbs, and specialty food items. Certain pharmaceuticals and medical supplies. The geopolitical dimension. This dispute is more than a bilateral trade issue. It reflects the intersection of three strategic priorities. 1. Energy diplomacy. For the US, Russian oil sales are a funding mechanism for the Ukraine war. For India, they are a means to keep domestic energy prices in check and growth on track. 2. Strategic realignment. The US has recently increased engagement with Pakistan, including proposals for oil development projects. This adds complexity to South Asian geopolitics and introduces competitive tension into a region where India has traditionally viewed itself as the primary US partner. 3. Multipolar economic order. India's willingness to trade with Russia despite Western sanctions underscores a broader shift toward a multipolar trade framework where no single power dictates the rules. The double standard issue. Critics of the U.S. policy note that other major importers of Russian oil, notably China and Turkey, have not faced equivalent tariff measures. China imports more Russian oil than any other nation and maintains deep economic ties with Moscow, yet Washington's trade approach toward Beijing is guided by a more complex set of considerations, including the scale of bilateral trade and the risk of economic retaliation. For India, this raises questions about whether the tariff policy is truly about sanction enforcement or also about managing the rise of a strategic economic competitor. Future scenarios. Several pathways lie ahead: escalation. Tariffs rise toward the threatened 100% level, significantly disrupting trade flows. India accelerates diversification away from the U.S. market, possibly expanding exports to Southeast Asia, Africa, and the Middle East. Retaliation. India lodges complaints at the WTO and considers counter-tariffs on U.S. goods. Negotiation. Partial exemptions are granted for certain goods, or a phased rollback occurs in exchange for limits on Russian oil purchases. Stalemate. Tariffs remain in place, with both economies absorbing the costs while maintaining existing energy strategies. The bigger picture. This tariff conflict serves as a microcosm of the emerging global economic landscape, one where trade, energy policy, and geopolitical alignment are inseparably linked. For India, the episode reinforces the importance of maintaining diversified trade partnerships and safeguarding energy security. For the US, it reflects a growing willingness to leverage trade access as a tool of foreign policy. The longer the dispute continues, the greater the risk of lasting structural changes in supply chains, trade routes, and diplomatic relations. In the context of global markets, these shifts will be felt not only in bilateral trade statistics but in the broader architecture of economic alliances. The U.S.-India tariff war is more than a dispute over trade. It reveals the delicate balance between economic sovereignty, energy security, and shifting geopolitical power. As India seeks affordable energy amid global uncertainty, and the US enforces its strategic priorities, traditional alliances are tested in a multipolar world. The ripple effects will reshape supply chains, alliances, and global trade rules, challenging policymakers and markets to adapt. This conflict highlights how energy diplomacy and trade policy are now inseparable in national strategy. The coming years will show how each side, and the world, navigates this new, fragmented order. Continuous analysis will be key to understanding its impact on global stability and power.